So if we had done this 25 years ago, it'd be a very short answer. So really, what we all grew up on was something called traditional long-term care. And traditional long-term care looks and feels a lot like a health insurance plan. There typically is a monthly or an annual premium that you're paying into a policy that's going to help cover the cost towards skilled nursing facility care, care in an assisted living facility, or home health care. I pay into these policies usually with the hope of never needing them in the future, very similar to my health insurance today. Now, for many people, there are objections to purchasing a traditional long-term care insurance because nobody likes to think of themselves as somebody that's going to end up needing this care in the future. So the evolution of life insurance-based options really came to the forefront starting in about 2010 when some tax laws changed. And we saw a lot of these life insurance companies starting to offer long-term care programs to their customers. And the benefit of having those options is at the end of the day, in the event that I have the best case scenario where I never need long-term care, there's a benefit that can be provided to my beneficiaries upon my passing. So that helps to overcome the issue of what if I never need it, why am I paying into something that I'm never going to end up using. Now there's two options that we see in those life insurance-based carriers that are out there. There's one where I write one check and I really just transfer an asset from one pocket to another at the end of the day. It's a guaranteed premium payment with many of the companies that are out there. So you may have heard about rate increases in the long-term care insurance industry, and that's one way where we can help mitigate those rate increases or those surprises down the road, is having a fixed guaranteed premium for a benefit that I might receive. With some of those programs, there's also going to be walk-away money. So in the event that I decide maybe long-term care isn't the right option for me down the road, maybe I don't want to insure against an event like this, many of those programs are also going to give me the ability to receive either all or a portion of those funds back in the event that I change my mind. So it gives me some flexibility. The other type is what I call a hybrid insurance policy. And that is really good for somebody potentially that's a little bit younger. Maybe they have a permanent life insurance need. They're thinking about purchasing a life insurance policy to help pay the mortgage off or put their kids through college in the event that something happens to them, replacing income. So with those features, I have policies that will give me the ability to access the death benefit for myself while I'm living to pay for a long-term care insurance claim. The downside being that if I do need those funds at the end of the day for long-term care, it does draw down that death benefit. So that's going to be a little bit less that's going to be left behind for my beneficiaries depending upon how much I take out of that program.